Welcome to this deep dive. If you're a construction business owner, a project manager, or really anyone tasked with navigating the beautiful, chaotic world of building things, you are exactly where you need to be.
Absolutely.
Because this deep dive is custom built for you. Our mission today is to, cut through the absolute avalanche of daily news, extract the real aha moments, and give you the actionable intelligence you need to lead your company.
Yeah, and we have an incredibly dense stack of sources to go through today.
We really do. We're drawing specifically from the Scaling Legends 2026 Construction Market Intelligence Briefing for March 8th, 2026. And I mean, the stakes in the industry right now, they just couldn't be higher right now.
No, they couldn't. We are currently watching massive, totally contradictory shifts happening all at once.
Right.
On one hand, you have this unprecedented high-tech AI infrastructure boom. But on the other hand, it's crashing headfirst into old-school, crippling labor shortages.
Yeah, it's wild.
All while we try to navigate what might be the most confusing regulatory and tariff environment we've seen in decades. It is just a very strange time to be building.
It really is. And just to give you a tease of what we're unpacking today, we're going to look at how a staggering $700 billion AI data center boom is actively triggering the return of 1800s-style frontier man camps in rural America.
Which is fascinating.
Right. And we're going to weigh that against the absolute supply chain chaos left in the wake of the latest Supreme Court tariff ruling.
Yeah, that's a big one.
But before we jump into the details of these policies and reports, we do need to make one thing crystal clear.
Right. The neutrality piece.
Exactly. Our sources today contain some politically charged content regarding recent administrative actions and trade policies. We are not endorsing the viewpoints of the content. We're simply trying to convey the ideas contained in the original source material.
Yeah, we have no political horse in this race. Our only job is to look at the ink on the paper and tell you exactly what it means for your bids, your supply chain, and ultimately your bottom line.
Exactly.
And that's a critical distinction to make because the noise surrounding these policies is just deafening right now. We need to separate the political headlines from the economic reality on the job site.
100%. And the most urgent reality facing our listeners today is obviously the cost of materials.
Yeah.
I mean, let's unpack this. The Supreme Court just handed down a 6-3 ruling in the case of Learning Resources Inc. v. Trump.
Right.
And the headline that flashed across every major news network was that the former Trump administration's reciprocal tariffs were effectively struck down.
Yeah, and if you're a contractor, your first thought was probably, oh, great, my material costs are finally going to drop.
Oh, absolutely. But the reality is much more complicated. The material-specific tariffs that actually hurt your margins,
They're still there.
they remain completely unaffected.
And this is where so many contractors are getting caught off guard this week. You really have to look at the specific mechanisms of the ruling. If you're buying steel, that 50% tariff is still there. Aluminum, still sitting at a 50% tariff. Lumber is still at 10%. And copper tariffs are completely untouched by this SCOTUS ruling.
Because the reciprocal tariffs that were struck down broadly targeted finished goods and general imports, right? Not the core raw commodities that form the backbone of your estimates.
Exactly. And just to add another layer of complexity to this, if you thought the ruling meant broader relief was coming down the pipeline, Treasury Secretary Bessent completely poured cold water on that.
Oh yeah, he did.
He announced that the 10% global tariff is actually rising to 15% this week. He stated that rates will effectively return to where they stood before the Supreme Court by August.
So put yourself in the shoes of an estimator right now. You're trying to put together a guaranteed maximum price, a GMP contract for a 2-year commercial build. How do you even begin to price that risk?
Honestly, it's a total estimating nightmare. You have a global tariff that dips, then rises to 15%, then theoretically resets by August, all while your core materials are still taxed at 50%.
You just can't absorb that kind of volatility.
You really can't. The Associated General Contractors, the AGC, is explicitly warning contractors not to hold their breath, waiting for refund checks on previously purchased materials.
Yeah, Construction Dive did an analysis, and they noted the net effect of this ruling is only a modest but meaningful reduction specifically for specialty equipment, HVAC, and electrical systems.
Right, but for the broader industry, the tariff landscape is arguably more confusing today than it was before the ruling.
Which means if you're a mid-sized contractor, you're bearing the brunt of this confusion, and we have the hard numbers on what that's doing to your raw costs. According to Smart Business Automator's Market Intelligence Report, The producer price index year-over-year jumps are just staggering right now.
They're brutal.
Aluminum mill shapes are up 33% year-over-year. Steel mill products are up 20.7%. Copper is up 15.7%.
Yeah.
And when you blend all of this together with the current policy environment, aggregate construction costs are still estimated to rise roughly 8%.
And that 8% aggregate rise is the silent killer. I mean, if you are not actively building escalation clauses into every single contract you sign today, you are essentially gambling with your company's future.
Oh, absolutely. That increase will eat your entire profit margin before the foundation is even poured.
Right. You have to have transparent conversations with project owners about shared risk, because fixed price contracts in this environment are just a recipe for insolvency.
So true. So you have these incredibly volatile material costs on one side of the ledger. But even if you manage to secure the steel at a price that won't bankrupt you, you still have to find someone to actually weld it.
Yeah, and good luck with that.
Exactly. Which brings us to a breaking report from Bloomberg on March 6 regarding the labor market. We are talking about a $700 billion AI data center boom.
The sheer scale of this infrastructure build-out is hard to even wrap your hair around.
It really is. Average monthly construction spending on these data centers has hit $40 billion. $40 billion a month.
What's fascinating here is the geographical constraint of this boom, because you can't build a hyperscale AI data center in the middle of downtown Manhattan or Chicago.
No.
You need cheap land, vast amounts of water for cooling, and massive amounts of power. That means these projects are being slated for highly rural areas, like the Texas Panhandle and the Dakotas.
But when you drop a $2 billion construction project into a town of 500 people, you run into an immediate physical limitation. There is literally no housing for the thousands of temporary workers needed to build these massive facilities.
Right.
So we're seeing an explosion of temporary man camp housing. Developers are literally having to build temporary villages out in the middle of nowhere.
Yeah, we're talking about massive dormitory complexes, industrial mess halls, and sprawling RV hookup grids just to house the labor.
It's crazy.
It is entirely reminiscent of the oil booms of the early 20th century or even the 1800s gold rush. You have these massive influxes of capital and labor into areas with zero existing infrastructure.
Who handles the sewage for a sudden influx of 3,000 workers?
Exactly. Who provides the food? The logistical overhead of just keeping the workforce alive and functioning is becoming a massive line item on these mega projects.
And the competition for that labor inside those camps is desperate. The Bloomberg piece highlighted that electricians are in such an acute shortage right now that recruiters are resorting to unbelievable tactics.
Oh, the private jets?
Yes. They're offering unprecedented raises, and in some cases, they are literally flying journeyman electricians into these rural sites on private jets.
That is insane.
Think about the pragmatics of that for a second. Chartering private jets for field labor, that eats up your project contingency fund instantly. It just shows how fundamentally broken the skilled labor market actually is.
Well, if we connect this to the bigger picture, those private jets are a glaring symptom of a much deeper systemic crisis in construction labor. The brief notes an industry-wide annual turnover rate of 68.2%.
Wow.
Think about the operational friction that causes. More than half of your workforce turns over every single year.
Let's ground that in reality. A 68% turnover rate means your safety manager isn't walking the site checking fall protection anymore. They're stuck in a trailer doing new hire safety orientations 3 days a week.
Right. The administrative burden of constantly onboarding and offboarding that many people is a massive drain on productivity. Furthermore, 70% of companies report they're actively struggling to hire.
Yeah.
And now, on top of the traditional shortages, we have this new retention threat emerging called quiet cracking.
Quiet cracking, that term just paints such a vivid picture. It's not just quiet quitting where someone does the bare minimum. It is the stress of these mega projects fracturing the workforce from the inside out.
Exactly. The workers aren't just leaving for $1 more an hour across the street. They are cracking under the pressure.
Yeah.
The mandatory overtime, the grueling conditions of being away from their families in these remote man camps, the constant push to meet impossible schedules is breaking them, and they are leaving the construction industry entirely.
And it is vital to understand that this isn't just an isolated American problem. Look at Australia right now. They're facing a perfectly parallel crisis. Their construction market is projected to grow to 256.14 billion Australian dollars by 2030.
Driven by a massive national infrastructure pipeline.
Right. But to hit that growth target, they need an additional 486,000 workers by the end of 2026.
And finding 500,000 skilled tradespeople in a country the size of Australia in under a year is just a mathematical impossibility under current training models.
It really is.
So this raises an important question. If human labor is this scarce and materials are this volatile, how are companies adapting to survive?
We got a huge window into that survival strategy at ConExpo 2026, which just closed on March 7th. It's North America's largest construction show, pulling in over 140,000 attendees from 128 different countries.
Yeah, if you want to see how the industry is trying to engineer its way out of this labor crisis, that is the floor you walk. The overarching theme this year was autonomy and intelligent control. Husco Gen Steer took home the Contractor's Choice Award for Best Equipment, and Gravis Robotics won for Best Technology.
But the piece of tech that really turned heads was Komatsu's PC220 LCI-12 Intelligent Excavator. They were showcasing full 3D machine control.
It's amazing.
The premise is fascinating. If you can't find a master operator with 20 years of experience who can grade a site perfectly by feel, you buy a machine that has the mastery built into its software.
Right. The machine won't let a novice operator overdig.
Yes, it automatically adjusts the boom and bucket based on the 3D site model.
It is brilliant technology, but ConExpo also highlighted a massive growing divide within the industry. While the mega contractors are buying fleets of these intelligent machines to offset their labor shortages, mid-sized contractors are deeply struggling with the practical adoption of autonomous and electric equipment.
Oh, I can completely see why. If I'm running a $50 million a year civil operation, I'm dealing with razor-thin margins. The upfront capital expenditure for a fully autonomous, 3D-controlled fleet is astronomical.
Oh, totally.
And beyond the sticker shock, if you buy electric heavy machinery, you run into the infrastructure problem again. If you're prepping a site in the middle of nowhere for a data center, the charging infrastructure for heavy electric excavators simply doesn't exist yet.
No, it doesn't. And because of these technology gaps, the labor pressures, and the tariff-driven ownership costs we discussed earlier, companies are having to radically shift their corporate strategies. What we're seeing is a massive wave of M&A mergers and acquisitions.
Interesting.
Both PwC and Capstone Partners are reporting a surging consolidation wave across the sector.
But wait, if I'm a mid-sized electrical contractor who is already squeezed by 15% jumps in copper prices and exorbitant labor costs, how do I even finance the acquisition of a competitor right now? Isn't taking on that kind of debt incredibly risky?
It is risky, but for many, it's seen as less risky than slowly starving to death. The strategy being deployed is to acquire scale. They aren't buying competitors for their book of business. They're buying them for their people and their assets. If you can't hire 50 electricians through traditional recruiting, you finance the buyout of a smaller electrical contractor just to absorb their workforce and their service trucks.
Oh.
The reports show outsized acquisition interest specifically for companies that specialize in data center and power infrastructure targets.
So you merge to survive. And if you aren't buying up competitors, you're fundamentally changing how you source your heavy equipment. The brief highlights a massive shift away from the traditional model of owning and maintaining massive internal fleets.
As noted in Smart Business Automator's Market Intelligence Report, the U.S. equipment rental market is approaching a staggering $50 billion in 2026.
That's huge.
Globally, that market is sitting at $159.39 billion, with the residential segment actually leading the charge at 38.47% of that share.
$50 billion just in rentals in the U.S. That is a monumental pivot in asset management. It means contractors are looking at a volatile market and deciding they don't want the liability of a depreciating asset sitting in their yard between jobs.
The data strongly backs up that sentiment shift. Google Trends is showing a 122.2% rise in search queries for equipment rentals.
Wow.
A big driver of this is the technology adoption gap we just talked about. The major rental houses are the ones with the capital to adopt telematics and IoT OA, the Internet of Things sensors across their fleets.
Right.
So a mid-sized contractor might not be able to afford to buy that Komatsu intelligent excavator outright, but they can rent it for the 3 months they need it for a complex site prep phase.
Transferring the maintenance and depreciation risk right back to the rental company.
Exactly.
Here's where it gets really interesting, because the shifts we're seeing in the U.S. aren't happening in a vacuum. If you want to know what is going to happen in your local market 6 months from now, you have to look at the global signals.
Construction is a highly interconnected global ecosystem. A policy shift in Europe or a supply chain bottleneck in Asia eventually ripples onto American job sites.
Exactly. For instance, up in Canada, they just signed a one project, one review deal on March 6th. This is huge for them. It streamlines their notoriously difficult permitting and environmental review processes, officially unlocking $116 billion in Alberta infrastructure projects.
That's massive.
Meanwhile, over in Europe, Germany is officially returning to 2.5% construction growth. That might sound small, but that is the first time they've seen positive growth in 5 years, confirming a real European recovery.
Yeah.
And in Asia, Japan is actively running lean construction study tours this month, trying to export their hyper-efficient waste-reducing management models to international firms.
While Germany and Canada are showing green shoots, we need to be very cautious about the signals coming out of the United Kingdom.
Oh.
Their residential market is taking a severe hit. UK residential starts have been slashed by 20%, which puts them down 36% compared to 2025. This is critical for our listeners to understand because the UK housing market is historically a very reliable leading indicator for the US market. When their residential sector catches a cold, ours usually gets the flu a few quarters later.
And unfortunately, we are already starting to see that chill hit the US housing data. Let's synthesize the latest numbers. If we look at the December 2025 starts, they annualized out to about 1.4 million homes.
Which represents a 7.3% drop year over year.
Exactly. And looking at the full year of 2025, building permits are down 3.6%.
But the nuance within that data is what matters most for business planning. The decline isn't uniform. It is almost entirely being driven by the single-family housing sector freezing up.
Right.
The multifamily sector, however, remains surprisingly robust. This is likely driven by the sheer unaffordability of single-family homes. High interest rates and soaring material costs are pricing buyers out, pushing a massive demographic wave into long-term renting.
So if you're a residential builder looking at your backlog for the next 18 months, the strategy is pretty clear. You need to pivot your resources.
Yeah.
Chasing custom single-family builds right now is fighting an uphill battle against macroeconomics. Shifting toward multifamily, townhomes, or high-density developments is where the capital is flowing.
It requires agility. And if we step back and look at all these sources together, the lingering tariffs, the explosion of AI data centers, the rapid shift toward intelligent rental equipment, and the diverging housing data, it brings us to a really crucial realization about where the balance of power is shifting in this industry.
Lay it on me. Where is the blind spot?
But we spent a lot of time today talking about the irony of using 1800s-style man camps to build the most advanced $700 billion AI data centers in human history.
Right. Same with the 340 gigawatts of Middle Eastern solar capacity. Very advanced tech.
Exactly. But there's a secondary long-term consequence to this setup that no one is really talking about. We're taking thousands of highly skilled, highly stressed workers who are already suffering from quiet cracking and concentrating them in isolated remote camps with limited amenities and intense working conditions.
That sounds like a pressure cooker.
It is the exact historical recipe for a massive wave of labor organizing. We haven't seen this kind of dense, remote concentration of skilled trades since the coal mining towns or the logging camps of the early 20th century.
Yeah, that's a great point.
When you have a massive workforce isolated together, sharing the exact same frustrations over conditions, extreme overtime, and safety, they talk. And they organize. The contractors who are just focused on winning the bid and ordering the steel, they are missing the human risk profile.
Yeah.
The next big disruption in construction might not be a supply chain bottleneck. It could be a massive organized labor movement born out of these rural mega project camps. The contractors who win this decade won't just be the ones with the best robots. They'll be the ones who master the human element of housing and retaining people in the middle of nowhere. If you aren't proactively managing the well-being, mental health, and fair treatment of your workforce in these remote areas, you are exposing your company to a massive operational risk.
That is a phenomenal point to end on. The isolation of these camps could be the catalyst for a labor shift we haven't seen in a century. You can't just innovate on your equipment. You have to innovate on how you treat the human beings doing the actual building.
Exactly.
Well, listen, if this intelligence briefing brought you value today, if it helps you make better decisions for your construction business, your estimating, or your team, we have a small favor to ask. Please subscribe to the show on your favorite platform, leave us a rating, write a review, and most importantly, share this deep dive with another contractor or your project management team. It really helps us keep bringing you this level of insight.
It really does.
And speaking of giving your team an edge, if you want to scale your business without drowning in paperwork, you need the right systems in place. To organize your project documents instantly, get automated daily log summaries, and catch schedule risks before they ever happen on the job site, visit smartbusinessautomator.com. Let the technology handle the admin work so you can focus on leading your people and protecting your margins. Thank you so much for joining us for this deep dive. Keep building smart, and we will catch you next time.